Good morning everyone and welcome to the Moneycontrol live stream. You're watching Markets with Santo and CJ. Well, on a day when hashtag RIP Twitter is trending on Twitter, whether it is time to also start trending Santo hashtag bull market is what we are going to be discussing in the spotlight segment. Now Santo, of course, if you look at the market generally, we are probably sitting close to just inches away from the record highs, right? And at that point of time, it's a very foolish question to ask that whether we are probably seeing an end to the bull market. But hear me out on this. And I know generally I've always been bullish, but I'm now starting to see some signs that probably the market is slowly and steadily peaking out. The first sign, of course, is the fact that the struggle that we are facing in crossing that record high mark that we had set in October 2021. Yes, Sensex has closed at a record high level on a closing basis. On an intraday level, it has still not crossed that mark. Nifty is still about 200 points away and has already been about 5 sessions since we have been waiting for that record high mark to come. But the most important indicator, Santo, for me is the India VIX. Now, if you look at the India VIX, it has fallen 75-80% from the record highs it had touched in March 2020 during the peak of the COVID sell-off. Or right now, it's sitting at almost a 14-month low. And generally, Santo, in the past at least last 10 years, whenever the VIX has fallen below 15, in the subsequent month and a half, 2 months, we have tended to reach the top for the market. We have seen that in last year, VIX had crossed the 15, had fallen below the 15 mark somewhere around mid-July and early August. And then just 2 months later, we topped out in the market. Similarly, in 2020 as well, after the initial sell-off in January 2020, when, the COVID pandemic just started in China and everybody was a little fearful, in February, our markets were sitting at record high and the VIX was almost at a low of 12 points at that juncture, because the viewpoint at that point of time was that COVID will not spread out of China. And we all know how wrong that thought process was of the global markets. And then we knew in March, we again topped out. Mid-February, we hit, record highs. And by March 24, we had fallen almost 30% from the peak. So I fear a little bit that there is complacency now creeping into this market. The entire narrative around India being an outperformer and probably staying an outperformer for the rest of its entirety of its history. Those comments about India itself being an asset class have started to make rounds again. We have heard those comments back in 2016. We have heard those comments back in 2018. We have heard those comments back in 2021. Every time you start seeing these sort of comments and headlines started appearing, the contrarian sometimes wonders whether this is the peak as far as the market is concerned. Also, another key indicator would be, and this I mentioned in yesterday's show, is the fact that the China ETF has outperformed the Indian ETF for the first time in many, many months. Now, if you look at China, India, and say, for example, another market that has been doing quite well in recent months, that is Brazil, India is sitting at peak valuations. For foreign investors, the incentive in terms of what sort of returns they can expect going ahead in the next 12 months is much, much, much lower compared to what they can get from bottom fishing in the Chinese market or the Brazilian market at this juncture. Also, the outlook for those markets is incrementally improving, where in India, we are not seeing any sort of incremental improvement as far as the outlook is concerned, Santo.
Well, CJ, I take the last point that you have made, probably that valuations are expensive and now money is flowing to other emerging markets. But that said, CJ, also remember that valuation itself is not a trigger for a bull market to end. Yes, that is one of the triggers, but not always the trigger. Secondly, CJ, I would look at another indicator. Like you mentioned VIX, I would say that the general mood on the street probably just gives you an idea, and at this point there is still some bit of skepticism. Typically, for the market to peak out, you need a lot of euphoria. We saw something like that last October, right? Stocks were just going up. Any and every stock was moving up, and making money had become very easy. Whereas here, if you look at it, people have not really made money in mid caps and small caps. They've made, of course, unless you were in the right stock, you've not been able to consistently make money. It's not as if you just jump in, pick any stock and you make money on that. That trend has not been there. But probably, I think, yes, maybe it will get a far more difficult to make money here on. But that said, I think I would still say that upside, the odds of a downside to me at this moment still look.
Santo, the fact that you mentioned that that the broader market has really not been performing as much as the large cap, especially if you look at the past 2 months, I think that also is an indication that probably the gains in this market are just too narrow to sustain for a very, very long time. Generally, when there is a good bull market, spreads happiness across the board. It does not just be selective in terms of just large caps and not mid caps and small caps. Probably the underperformance of mid and small caps also goes to show that there is safety among fund managers in the sense that they are going for the tried and tested at this point of time. Of course, you have time and again talked about the macroeconomic uncertainties. We already now have JP Morgan and Morgan Stanleys of the world making a recession in the US their base case, which was not the case at least 2 weeks ago. So going ahead, the macro narrative is going to be much more against the growth outlook in India. At this point of time, we are seeing multilateral organizations time after time coming down and downgrading India's GDP growth expectations for FY24, FY2023 as well as FY24. So when earnings growth, when GDP growth itself is going down, and if the RBI is right, inflation is also coming down, your nominal GDP growth is also going to come down. That means your earnings expectations will also come down with that, and therefore your returns, because ultimately market is slave to what earnings companies project. That said, if you look at the earnings momentum itself, clearly that upgrade cycle that we were seeing in 2021 is also no longer there. That if you look at after the September quarter, there has not been much upgrades to aggregate earnings. Individual earnings is a different conversation altogether, but if you look at aggregate BSE 500 or aggregate Nifty 50, there have not been much room for earnings upgrade. But that said, ultimately, if you talk to investors from a longer term perspective, clearly, this will still be a market where buy on dip strategy will continue to work. Over the next 12 months, things could be a little ugly, could be a little uncertain, but over the next 5 years, clearly, buying on dip, as it has worked for the past 5 years, may continue to work.
Well, let's also not forget, so far earnings in most sectors, even if they are not spectacular, they have been broadly on expected lines, and there doesn't appear to be any risk to that at this point in time. Also, inflows into MMs at this point are pretty strong, CJ. So that money flow does paper over a lot of other problems.
Absolutely, Santo. That said, let's take a quick check on the market setup for today, and the SGS Nifty futures are indicating a muted start again. But the market, it just looks like very lackluster, as if investors have just lost interest at this point of time, or maybe they've just lost a sense of direction, probably as we are heading towards record highs. Wall Street, the cues from Wall Street also were negative. Benchmark indices there ended lower after global bond prices actually fell, or the global bond yields, which move inversely to prices, rose quite sharply. That said, the positive for the bulls would be the fact that crude oil prices have dipped below the $90 per barrel mark for the first time since October. There was a massive, almost a $3 decline in crude oil prices overnight, so that should be a good indicator as far as the bulls are concerned.
Well, and some bit of nervousness around record highs are always the case, CJ. Nothing surprising really here. But that said, the uptrend could continue. It might get a little more narrower from here on. And a quick check on the FNOQs. Now we're seeing short covering in the futures of GMR Infra and ABB. There's some long build-up seen in Exide Industries and Tata Consumer. And lastly, we're seeing short build-up in Aarti Industries, Metropolis Healthcare and InfoEdge.
Well, the newsmakers of the day today, and the first one on my radar today would be again Nykaa. I mean, block deals just are not stopping for Nykaa.
That bonus issue fine in the end
absolutely
hasn't really yielded much.
It's not working out clearly at this point of time. Maybe at least the price damage has been controlled, but it's not really stopping for those who really wanted to sell out on the stock from doing so. And latest on the block now is TPG Capital. TPG Capital is said to be offering about shares worth about $125 million today in a block deal trade. I think as the market opens, we will see that trade being executed. So watch out for that. That said, though, Santo, on the other side, if you look at the buyers who have been emerging from some of the block deals that are happening, yesterday also about 1,000 crores worth of shares were sold on the counter. And interestingly, Canada Pension Fund, which is a long-only fund with a long-term horizon, they ended up buying about 1.7 crore shares of the company. So indicating that of course there is a tug of war happening. Some are seeing value, while at the same time the question beckons that why are pre-IPO investors exiting at this point of time?
Well, and Fortis Healthcare is my newsmaker of the day. Now, the Securities and Exchange Board of India has asked Malaysia's IAH to get the Delhi High Court's nod for making an open offer. There's been some anticipation that the open offer would come soon, but again CJ remains to be seen if that will really fire up sentiment for the stock, because even if an open offer does happen, IHH plans to make an open offer for an additional 26%. It already has a 31% stake at this point in time. Even if that open offer is made, remember IH had bought the initial 31% stake at 170 rupees per share. So, the open offer also would be around that price itself. And Fortis stock today is at around 285 rupees. So, remains to be seen whether that will make much of a difference. As such.
I mean, clearly it will, if they were to end up offering any sort of premium to the current market price, it will clearly, jack up the cost of acquisition for the company, for IHH Healthcare, and I don't think they'll be happy with that sort of a scenario. That said, moving on to the hot brokerage bets of the day, and the first one from Santo's radar.
Well, Info Edge, CLSA has rated it an underperformer and has also trimmed its target price for the stock to 4100 rupees. Now, what CLSA is saying is that one of the major negatives for the company at this point in time is that the hiring demand in the IT sector appears to be slowing. Remember, it's the hiring vertical, Naukri, which seems to be doing very well for Info Edge at this point in time. It's other three verticals, which is real estate, education and matrimony. They're doing well, however, they're still in an investment phase. And also the management has said that in the short term, it plans to give priority to market share gains rather than growth, which means there could be some pressure on profitability for a while.
Absolutely, Santo. And my top brokerage bet of the day would be Syrma SGS, a recent debutant on the exchanges. Now, ICICI Securities came out with a note on the stock. Now, they have retained their buy rating on the stock and a target price of $350. And the positivity on the stock is largely driven by the strong order book of about 1700 crores that Syrma SGS has at this point of time, which they believe will drive earnings growth in the second half of FY23 as well as the entirety of FY24. Apart from that, ICICI Securities has said that they are expecting the stock or the company to continue to gain market share in multiple segments that it's currently has its operation in, and overall they're expecting sales growth of about 33% on an annualized basis and net profit growth of about 48% over the next 2 years. That is a view coming out from ICICI Securities, Santo.
And well, with that, let's move on to the stocks on our watch list this morning, starting with Blue Star. Now, the stock has been under pressure for the last few days. It's been the third consecutive quarter of decline in top line. However, CJ, the management is sounding pretty optimistic. In fact, it has stood by the guidance that it had made at the beginning of the year. It's saying that the order book in the B2B segment remains pretty much robust at this point in time. The other major positives include the company being able to expand its market share in northern India, and it is also seeing strong demand for room ACs in the fourth quarter. Now, the margins for the first 2 quarters have been close to about 6%, 6 to 7%, but the company has said that for the year as a whole, it intends to report a margin of close to about 8 to 8.5%, which means that for the next couple of quarters, there will be a significant improvement in margins. Besides that, the company has also said that it's on track to achieve its guidance of a 13.75% market share in the room AC segment, and it plans to increase that to about 15% in the next couple of years.
Santo, it will be great if it can exit the year at 8.5. But before we come back to my point of view on Blue Star, let's quickly take a check on the market. We have a positive opening, surprisingly. So clearly, the Nifty 50 and the Sensex rising about 0.2%. So it will be interesting to see if those gains sustain. But it seems like the broader market is doing quite well. The Nifty mid cap and the Nifty small cap indices in the positive territory, higher by about 0.3% each, helping therefore the advance and decline ratio, which is now in the favor of advanced Santo.
Well, Kotak Bank and Asian Paints among the gainers in early trade. UPL is under pressure. The market breadth seems pretty interesting given that mid and small caps have not been really performing all that well, but at least in early trade, clearly the momentum seems to be in favor of the small and mid cap share. Hero MotoCorp, again M&M, those are the losers in early trade, down close to about 0.5%. Tata Steel is flattish at this point in time. Grasim is down by 0.2%.
Yeah, Santo, and sectorally also, almost all of the sectoral indices on the NSE right now in the green territory. So that is a good start as far as the market is concerned. India VIX also, Santo, now below the 15 mark once again, down about 1.5%. At 14.9 at this point of time, 14.7 actually, now 1.5% down. So clearly, again, indicating that the market is becoming less and less fearful, as I said earlier in the show. Now, coming back to Blue Star, Santo, now it will be interesting to see if they can actually, maintain that guidance of 8 to 8.5% for FY23, because if you look at the second quarter numbers, clearly the company's margins did decline not only on a sequential basis but also on a year-on-year basis as well, suggesting that cost pressures still remain quite elevated for the company. But apart from the fundamentals, I've spoken about this earlier as well, that on a technical level as well, it just doesn't seem like the market really has any sort of confidence in the stock at this point of time. The stock has fallen about 5 to 6% just in the past month, despite the the commentary that has been coming out from the management. If you look at the technical charts, the RSI has fallen below the 40 mark, clearly indicating that momentum is very, very weak on the counter. Also, the stock is trading below its 50-day moving average, which generally is an indication that profit booking will continue probably in the very short term on this counter. So at this point of time, while the management's guidance has been, or at least its ambition has been very strong, we'll have to wait and see whether the market is convinced that they can follow through on that guidance. Well, my stock, or the stock that will on my radar today, would be United Spirits. Now, the reason why United Spirits could be buzzing today is because of the fact that Radico Khaitan recently was allowed by the West Bengal government to take a price hike on its products. Now, analysts believe that up next would be United Spirits' turn, and because United Spirits gets about 8% of its overall revenue from West Bengal, clearly this will be a very significant improvement or a significant event for United Spirits, especially from margin side, given that margins in the second quarter were quite weak for most alcohol beverages companies. That said, there is an expectation also that going ahead, a lot of southern Indian states, which is a big chunk of United Spirits revenues, they will also probably be much more open to price hikes, given the fact that cost pressures have increased quite rapidly for a lot of alcohol beverage companies. Apart from that, going ahead, of course, the price hikes should aid the gross margin improvement for United Spirits, but analysts also believe the fact that the company has now halted the utilization of mono packaging for many of its products, that should also improve gross margins quite rapidly in the second half of FY23. Overall, the demand scenario remains still quite okay for United Spirits. If you look at the premium or the prestige and above segment, the premium segment generally, there the demand was very, very strong, although mass consuming products did see a little tepid growth. But overall, given the strong demand in premium segment and with these sort of measures coming in, I think margin performance ought to improve for United Spirits, Santo, going ahead.
Well, yes, very hard to pick holes in that one, given the strong second quarter numbers that the company has posted, both top line as well as net profit. Yes, and you've also flagged the margins, but that's what exactly I was also coming to. Margins still are a bit of a concern. Input costs are pretty high, and that is one of the reasons probably the market is unwilling to give a higher multiple. If you see, the stock peaked around February, but since then has been struggling. So till the market seems to get some kind of comfort on the margin part, then I feel that valuations could be a bit of an issue for further re-rating. And next stock on my radar is IPCA. Again, a decent set of second quarter earnings there. The API market, that active product ingredients segment of the company, has not done all that well, but that's been the story for quite some time now. But at the same time, the formulations part of the business has done pretty well for IPCA. Now, IPCA earns about 45% of its revenues from the formulation business, and that has grown close to about 10% year on year during the quarter, and that will continue to be one of the major areas. Besides that, the situation for API CJ is also expected to pick up now that the inventory levels in most channels, they are normalizing. There was a lot of stocking which had happened, and because of it, demand had slowed down, but now those inventory levels everywhere is coming back to normal, and that should help a company like IPCA. Lastly, in the sartan API business, where right now it's China which is really calling the
Dominant player,
shots,
yeah.
but at the same time there is some bit of improvement for IPCA as well. It is making slow and steady gains, and besides the supply constraints which were there with the commissioning of the Devas and Ratlam plants, that should also be taken care to a large extent.
Yeah. Santo, for me,
please.
of course, I think the entire pharma space at this point of time just is not attractive enough. With the return of US FDA inspections again, I think the level of uncertainty that probably had dissipated the past 2 years has again come back, and so therefore, of course, the regulatory uncertainty, which then affects your earnings visibility, that makes me a little cautious. And B, if you look at the growth rates that a lot of these pharma companies are posting, even in the mid caps space as well, is just not attractive enough. I think there are much better, much more quality options out there in the market to be putting your money in than I think anything at this point of time, especially in the mid cap pharma space for me.
Well, and last stock on my radar is NBCC India. A quick one here. The company's order book has declined by close to about 160 billion and now stands at about 450 billion. If you consider the subsidiaries also, that put the order book goes to about 550 billion, but according to Antique, the order book position is still a bit misleading, because if you look at the execution, that has been pretty tardy, and that's one of the reason it has rated a sell on the stock with a target price of 25 rupees. Now NBCC stock has been doing well of late. In fact, it's risen close to about 20% over the last month or
Very
so,
sharp
but
increase.
NBCC Antique is pretty bearish on NBCC at this point.
Well, Santo, I think there is not really much case to make, especially after those sort of outlook and numbers coming out from NBCC. Even if you look at it on the technical charts, the stock is looking extremely overbought because of reasons you mentioned, the recent spike that we have seen in the stock performance over the past month. If you look at momentum indicators like RSI and money flow index, they are now trading above the 70 mark, clearly indicating that there is a possibility of some profit booking happening again. And yeah, after a stock has seen about 25% rally in 1 month, you would expect that some bit of cool off will happen on the counter. And after these sort of comments and thought process coming out from Antique, I would think that some investors might be tempted to take some profits on the stock going ahead. Well, Santo, looking at some of the queries coming in from our viewers, and a very interesting stock which probably doesn't prop up on our show that too often. Krishna S wants to know our thoughts on Vodafone Idea, Santo, for the long term. What do you think?
Well, it's been a trading bet for a fairly long time, CJ. If you look over the last 1 year or so, every now and then there is some news flow about the health of the company. It's been unable to make any significant market share. Well, there is some improvement at the margin here and there, but that said, it's still a very distant number 3 without any realistic chance of even moving up to anywhere closer to the number 2 player at this point in time. So to me, it seems like a trading bet. There is extreme pessimism, stock falls sharply, and then suddenly market comes to the view that maybe things are not so bad after all. They give a chance for survival. The fundamental side of the picture clearly is not at all looking good for Vodafone. But CJ, your thoughts?
I think, Santo, this is a company, when the government support measures had come in, I think somewhere in 2020, end of 2020, early 2021, clearly there was a lot of optimism that finally now the company will be able to survive. At least the survival scare was gone, and now the next focus will be to how to make it come back to the pink of health that it was probably before the intense competition that was brought into the sector in 2016. Now, if you look at Vodafone, clearly it's not been able to raise funds so far. That has been a big dampener for investors. There has been talk of the company being able to raise funds, but that has not really materialized so far, and clearly indicates that a lot of people out there, especially big investors out there, are not really willing to touch the company at this juncture, especially because of the fact that there is not much backing coming from the promoters themselves, and that is another crisis of confidence that the company is facing. Apart from that, it is dependent on improving its operating profits or operating performance largely on tariff hikes, and at this point of time, given that we are largely a 3-player market and it's Jio and Bharti Airtel who are setting the tone in the market, until unless they go for a rate hike, price hike, it is very unlikely that Vodafone itself can raise prices. Also at a time when it's losing millions and millions of customers almost on a monthly basis. So clearly the going is looking very, very tough, and you can see that in the stock price performance as well. Some of the big brokerages who had turned buyers of the stock when the government support measures were coming in have in the past 12 months have turned sellers on this counter. So clearly the view of the market is quite negative, and I don't think that is going to change anytime soon. Well, Santo, another thought coming in from Naval Sharma. He wants to know that Paytm is getting beaten black and blue. Is it time to buy this dip or avoid?
Well, this is right up your street, CJ. So
well, I will,
should,
of course,
it should begin with you.
True, and Naval, of course, I'll not, I can't recommend whether you should buy the dip or avoid. But see, all I can tell you is what is the context around Paytm at this point of time, and from a standpoint of incremental gains. Paytm's story is slowly and steadily improving. Of course, it started off on a very, very bad note for Paytm. That crash on the IPO day, then the subsequent commentary coming in from the management, which really got everybody very confused as to what Paytm really was all about. But in the past few months, they have corrected a lot of those issues. Their analyst calls have become much more clearer. Now they have, of course, guided that they are going to turn profitable at an EBITDA level or operating profit level from October, September quarter of FY24, that is next year. So all of this, if you take that into account, and also if you take into account the sequential improvement in earnings that we are seeing from the company in the March quarter, the June quarter, as well as the September quarter now, I think that clearly shows that the company at least is now headed in the right direction. The entire startup space, of course, the focus has now changed to becoming more profitable instead of burning cash for growth at any cost. Since that shift in mentality also has happened, I think there's a good chance that this company could turn profitable by next year. And then, of course, the market will take its own view as to whether valuations are justified or not. That is, of course, ultimately the market's call. There will be, of course, different thought processes around whether Paytm is a value stock right now or whether the valuations are still expensive.
Well, in the short term, I think that there will be concerns if overall market sentiment changes for the worse. Typically, investors tend to stick with those companies where you have better visibility of earnings, and on that count, Paytm falls a little short. So, if you were to look at it from a short-term perspective, clearly things are not looking good. We'll continue to see a lot of fluctuations. Again, here also, as we've been seeing in quite a few stocks, there is extreme pessimism all of a sudden. So, you might see some sharp moves here, which from a trader's perspective looks pretty interesting, but for a long-term investor, I think it's going to be a fairly long wait.
Well, Santo, before we wrap up the show, you can see the market. The market has now turned into the red territory. So clearly, at this point of time, there is just a sense of a lost direction in the market. It's just not being able to get that last kick to probably go above the resistance level around the record high levels or all-time high levels, and that is, as I said at the beginning of the show, is a little concerning for me, given the fact that it's almost been a week that we have been trying to get past that level, Santo.
It's just down 16 points, CJ.
Doesn't matter, Santo. The fact that we've been oscillating from starting off on a good note, then falling off, and then probably either ending near day's low or probably just recovering and ending in the green territory.
Well, and with that, we wrap up this episode of Markets with Santo and CJ. Thanks for watching and also sending in your queries. Continue to send them and we'll try to answer them to the best of time and ability.
Of course, and guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live at 3 p.m. with all the day's action. Till then, have a great day.